Hello and welcome to another episode of Trust Issues. Today I'm sitting down with Richard Sennitt, manager at Schroder Oriental Income, to talk about the fund and the opportunities for investors in the Asian income sector. Richard, many thanks for joining us today.
Thank you very much for having me. Delighted to be here.
Could you start off by providing an overview of the objective of the fund and also the current portfolio in terms of sector and country weightings?
Yeah, absolutely. It's obviously a income-orientated trust, and the objective is to provide a total return for investors, primarily through investments in equities and equities-related investments of companies which are based in or which derive a significant proportion of their revenues from the Asia-Pacific region and which offer attractive yields. So very much a broad-based objective in the sense of trying to generate income from the region, and it is broadly spread by country and sector. From a country perspective, I think the best way to think about it almost is divided up into four blocks. You can think there's the North Asian markets of Korea and Taiwan, which are primarily very export-driven markets, and they make up just under 40% of the portfolio. And then you have Hong Kong and China, which make up roughly about a quarter of the portfolio. And here we would be very underweight. We are very underweight in China, relatively overweight in Hong Kong. And then we have a third block, which is more the Southeast Asian markets, so including Singapore, Indonesia, Philippines, Thailand, and Vietnam. And they make up just over 20% of the overall trust as well. And then finally, last but not least, we've got Australia, which is around about 20% in the portfolio. So as you can see, it's quite well diversified by country. And from a sector perspective, it similarly is, although there are two, what I'd say, bigger sectors within the overall makeup of the fund. They are financials and IT, and each of them roughly makes up 30% of the portfolio, and we are overweight both of those.
And could you talk us through your investment approach in terms of how you assess value and also what attributes you look for in a potential investment?
Yes, from a philosophical perspective, we have a fundamental bottom-up approach to investing, and that's because we believe that the markets are inefficient in Asia, and the best way to extract those inefficiencies is from a bottom-up approach. What we don't do is screen the universe for yield and backfill the portfolio with the highest yielding stocks. So what we're actually looking to do is to buy stocks that have an income rationale to go in the portfolio, but also have a potential for upside from a capital perspective. As far as companies go, we're looking into buying what we view as quality businesses, those that are able to sustain higher level or in fact grow their return on capital over time. These tend to be companies that have strong management, have got decent corporate governance, and so tend to allocate capital well, which obviously from an income perspective is important. We obviously pay attention to valuation, so try and look out at a company's earnings profile into the future and say, is the market paying the right price for that sort of earnings streams? So what we're doing is trying to really buy quality companies, but at the right price.
So why do you think this sector lends itself well to active management? And a second part, how is SOI differentiated from its peer group?
Key point in my view is that we believe markets are inefficient and less well researched. And it's not that people don't research the market, but more they tend to take a shorter term view, which can often mean that markets end up being more volatile in the nearer term. And we as long-term investors can take the other side of that, if you like, and try and take the longer term view and take advantage of those times when stocks move up or down on short-term news flows such as quarterly results. And it's also actually why we focus on quality companies, because Asia does tend to be a bit more volatile than other markets. You want to be in companies where you're confident about the quality of the business that you're investing in. One of the advantages that I have working for Schroders and running the fund in the way that I do, I think, is that we have a very large resource based out in the region, which is a large experienced team of over 40 analysts across 6 offices, and they go out and visit companies regularly, write research, set fair values, and I can draw on their best ideas from across the region to create a portfolio of around about sort of 60 odd stocks. And I think that having a team like that and applying a disciplined approach over time increases our ability to add value in the longer term.
There's been a sustained effort to cultivate a supportive dividend culture in Asia over the last decade, due in part to corporate governance reforms. Do you think the region is still overlooked by income-seeking investors?
I think that the region is perhaps not focused on as an income-generating region. And I think there's still a bit of a view that when you invest in Asia, you're investing in a growth region from an economic standpoint of view, and therefore you want to be invested in perhaps growth stocks. But I think what that tends to leave out or forget is that over the longer term, actually what you find is that just over half of your total return comes from the reinvestment of dividends. So sort of income as a portion of that total return has been a significant driver of return through time. There's also, I think, perhaps a view that when things get tough, that somehow dividends paid by companies in Asia are going to be cut more than they might in other markets. In my view, I think the region actually is pretty durable from a dividend perspective. And I think we've seen that through the GFC, through COVID. Yes, we did see some cuts in dividends, but they held up pretty well in a global context. And I think this is in part because payout ratios for the region are relatively low compared to where they've been in history, and means that dividends are still sustainable even if earnings do get revised down, and also gearing of companies. So the indebtedness of the corporates across Asia tends to be relatively low versus other regions as well. And therefore it means that when earnings do come under pressure, there is an immediate need to cut dividends in line with earnings, say.
And staying on the topic of returns for a moment, what are some of the key drivers in terms of supporting capital growth?
Yeah, and I think it's an important point because, as I mentioned earlier, when we look for stocks to put into the portfolio, we don't just put in the highest yielding stocks, look for stocks that also have capital upside. This is in part as just because the company's paying a high dividend today, it doesn't necessarily mean that it's going to be able to continue to pay that dividend over time. And so when we're investing in companies, we want to have, from an income rationale, we want to have companies where we think that the dividends are going to be more durable and more sustainable over time. It's probably worth mentioning that our process when we're looking at companies doesn't differentiate between whether this company is going to be for an income portfolio or a non-income portfolio. We have a consistent approach to the way that we look at the stocks and the way that we invest. And obviously, though, stocks that end up in the trust will always have an income rationale as to why they go into the portfolio.
And could you talk us through recent performance?
Yeah, over the last year, markets in Asia are mid to high single digit in sterling terms, but they have lagged global markets. Although the last few months, actually, Asian markets have started to do a bit better, and I think that's in part down to China rebounding from what was quite a cheap, relatively oversold valuation point, in my view, and also a continued driver from a pickup in IT-related names, sort of, I guess, following on for the trend that we've seen in many other markets, particularly in the US. It's probably also worth pointing out that during the last year, value has outperformed growth, and that has been helpful for an income strategy in the sense that income is a value factor, and so that has been a bit of a tailwind. And against that backdrop, the trust has outperformed its reference benchmark by just over 4% to the end of May. And this is principally being driven by a stock selection in Taiwan and Korea, as well as an underweight to China. Like elsewhere, as I said, IT stocks have performed strongly, and our positions in some of the Taiwanese names have done particularly well. And there, it's really, I think, a combination of two things that's driving that. First, you've got a cyclical component in the sense that these stocks are coming from a cyclical low. We know from after COVID, there was lots of excess inventories built up in a lot of industries, including semiconductors and so on, which had to be worked off as people stopped purchasing things and went and consumed services. To that, we saw a big supply side response from a lot of the IT names. So they cut back on production, they cut back on CapEx, and this actually saw the sort of demand supply imbalance start to work its way through the system. And so from a cyclical perspective, we're just starting to see that improve. And then, of course, there's been more recently the structural driver around AI means for the industry and how that's going to grow. And as you know, IT companies in places like Taiwan and indeed Korea are beneficiaries from that trend as well. So we've benefited from being overweight in IT. And the other area I would say that we've done well from is our stock selection in financials, which was also strong and actually more than offset the negative that we had from being overweight to real estate.
And on a similar note, could you explain the steps you take to manage downside risk for investors in the trust?
Yeah, we tend to run a relatively diversified portfolio. So from that perspective, we've got just over 60 names, and they're reasonably well diversified both by sector and by markets. And within that, we would expect sort of typical ranges for sector and regional country to be plus or minus 15% or plus or minus 20% respectively. So there's a guide. And it's also probably worth thinking that, or remembering that the income asset class as a whole tends to be slightly lower beta than the overall market. And the fact that the companies we tend to invest in tend to be what we view as more quality businesses. So there's this quality bias. The very fact that companies are paying a dividend means that they do have a focus on shareholder return. One of the things that we look for in stocks is companies that have got good corporate governance. And, one of the signs of that tends to be returning of cash through the paying of dividends. So from that perspective, income stocks can sort of tick that box there as well.
Which parts of the market do you find most interesting at the moment?
Yeah, I think there's sort of two areas which I've sort of touched on, which were sort of IT financials, where we've got reasonably large exposure. I think from an IT perspective, I sort of mentioned the drivers for that area of the market, both the cyclical recovery plus the sort of additional structural growth. Having some of the world-leading companies in those areas for the manufacture of semiconductor chips is obviously a great boon to the region. I would say that obviously this area has done well. And, some areas have re-rated up, and we've been seeing a bit more in the way of retail interest in certain areas of the market, which has meant that we have been sort of within the IT area starting to rotate or trim some names that have done particularly well. But the relative valuations for a lot of these names still don't look, in my view, extended compared to history and to other names globally. And the other sector I would mention would be financials. And, when we tend to think of financials, we think of banks, but it's quite a heterogeneous sector in Asia. So you're looking at sort of banks, exchange companies, insurers. So there is quite a cross-section of names. Banks would fall into two categories. One, it would be more that sort of traditional higher yielding, slightly lower growth name where financial penetration is already relatively high. And so markets such as Singapore there look attractive from a banking perspective. And these stocks benefited from rates staying higher for longer. And also the other area, which is where actually credit penetration is still at a relatively low stage. So they would be banks in places like Indonesia, where you're sort of benefiting from the trend of increased financialization within the economy. And I think that those areas should continue to do relatively well, in my view, given where valuations are.
Looking forward, we seem to be nearing a fall in US interest rates at some point, which has typically been a tailwind for Asian equities. Do you think this is still likely to be the case?
I think it's definitely, if you look back at history, when we've seen sort of rates peaking, and in particular the US dollar easing back as well, which is fairly typical in that sort of environment. What it has been positive for Asian equities. If you think about the transmission mechanism, why is that? It tends to be because as rates come down in the US, liquidity tends to ease within the sort of periphery, so many of the markets in Asia, and then there's scope for for rates to also come down in an Asian context as well, which is generally speaking helpful for stock markets. So I think that does still apply. I mean, what's been quite interesting year to date so far is that we've seen, expectations for rate cuts sort of ebb and flow. So for one moment, we're looking at quite a series of interest rate cuts, and that's obviously come back in more recent times. And I think consensus is now much more for only one cut this year, possibly two. So that will, I think, be still a driver of sentiment towards the region.
That seems a positive note on which to end today. I'd encourage you to visit the Schroders website to find out more information about the trust, and I can particularly recommend Richard's insight articles covering investing themes in the region. We also have a wealth of information available on the Kepler Trust Intelligence website, including our latest research note on the trust. Thanks to Richard for joining us today.
Well, thank you very much for having me.
And we hope you join us again soon for another edition of Trust Issues.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.